I feel like it doesn't matter which industry. I cover a lot of different industries, and what I hear, whether it's cruises, whether it's travel services, whether it's gambling, whether it's insurance, is AI dominating. So Nicholas, when you are looking at VanEck's SMH, it's been the benchmark ETF for semiconductor space now, and you've got a new variant, SMHX, which has just passed the general industry accepted benchmark of longevity with assets under management of a little more than $100 million. So when you're looking at semiconductors and AI and the push for the future, what separates this from its predecessor?
When you look at, or when we were reviewing the success of SMH and determining what was driving the long-term performance and what were the key drivers of performance largely, you start to bifurcate the holdings and start to look at one. SMH was largely well constructed because of the fact that you have this team of winners, right? So NVIDIA leads the charge with systems and GPUs. Then you have their TSMC, which does all the manufacturing. ASML buys all their equipment from TSMC, et cetera, et cetera. And it's become like this oligopoly down the stack. But then when you start to dissect that and look at the parts of the portfolio that may be the drivers of scaling AI forward, we looked at the Fabless names, right? So a Fabless is a company that designs the chips, but they outsource all of the manufacturing. So as we look at AI and are trying to, look over the long term of where there might be opportunity, silicon touches everything that is technological in our lives. And that's no different for AI, right? And the Fabless names, having the low CapEx and being able to take that excess cash flow and invest it in R&D, hiring better people, just looked like it was going to be a big driver of performance and where the opportunity lie for semiconductors moving forward. Not to say that the broad-based basket of top semiconductor names isn't going to continue to drive the market forward, but looking into the semiconductor space, we believe there was just an opportunity set there. And as you guys talked about before, right, there's a lot of ETFs in the space. It's very hard and difficult to try to find something new, differentiated, and also be a strategic opportunity for our clients. And we really believe that the Fabless space checked all those boxes.
Okay, so I'm just going to run through some of the top 10 holdings in this Fabless semiconductor ETF in the SMHX. NVIDIA, Broadcom, Astera, Synopsys, AMD, Cadence Design, Monolithic Power, Rambus, Qualcomm, ARM Holdings. You say these firms are solving for bottlenecks, for interconnectivity and efficiency and power. In those subcategories, which one has the most growth potential?
I think interconnectivity, the movement of data, right? As these systems become more and more complex, you're going to have to be able to move the data faster in more nuanced ways. Our view is that AI is probably going to splinter, right? You're not going to have one large language model do everything. You're already starting to see that with some of the foundational models out there. But even more importantly, I would say that the power, right, and being able to be more efficient is extremely important. So if you look at monolithic power systems, they're going to be a supply chain, or they're going to design chips to help with the power consumption of these different models and of the data centers. So I think primarily the two of those, right? Making the products more efficient and be able to do that, and in the same breath, making them more power efficient is extremely important as AI continues to grow and the use cases continue to stack up.
You mentioned the deceleration. If it's sort of like we saw this initial gold rush, everybody's going there to stake the claim. They don't know whether it's worth anything, but they're just going to get there and own the space first. If we're seeing that rush decelerating, will that affect the Fabless semiconductor companies as well, or are they still playing catch up?
I think you have to look at we do this specifically as ETF asset managers, right? We really want to have a long-term perspective. Are you going to have specific price pullbacks inside of this AI growth? But we believe this is a super cycle, right? And that AI is not, we're in the very early innings of this. You still have these major players developing the foundational models, throwing hundreds of thousands of GPUs to make compute even better, right? The more compute we throw at it, the better the model gets, is essentially what's still happening, right? So we haven't even seen that come to fruition, or a law of diminishing returns when it comes to that. So we have to look at it and say, first you have this foundational layer where they're still continuing to build out data centers, but then you take that one step further and you look at the application layer, right? And how much compute is going to be needed as we start to push that application layer out. You start to move out to the edge, and then you start to look at the designers, and they're the ones that are creating these efficiencies, right? They're the ones helping move AI out to the edge. You can't put a GPU in a smartphone, right? It just, that's not the way it works. So you need Qualcomm, you need all of these different fabless designers that are going to help the silicon move closer and closer to the end user, so that AI becomes even more prolific in everyone's lives. And we believe that's essentially what's going to happen. And it's just a matter of time. And is that 5 years, 10 years? We don't know.
Given the outsourcing component here, how do you think of tariffs and the threat of more tariffs?
I wouldn't comment on what I think. A lot of it is rhetoric, ultimately, at the end of the day. And maybe that's, personally, subjectively, my opinion. I think at the end of the day, we want to be the leaders in the United States when it comes to AI, and we are. And if you look at how the leaps that NVIDIA are taking, and you can hear Jensen on his most recent earnings call talk about how far ahead they are, the purchase orders they have. You look at the tariffs, largely these are US companies. And I think what makes them even more attractive is if you look at NVIDIA's business model, 5 years ago, 6 years ago, they were a gaming GPU company. That's what makes this attractive, right? Is their ability to pivot and be nimble and design, and not have the infrastructure associated with their build outs, right? And that they can design new chips, fix new bottlenecks, and help continue to drive the technology forward. So I think if you look at the long-term opportunity set, the designers, largely make more sense if you're looking at it from a risk perspective with tariffs.